The beta arb summary, if your benchmark is the S&P 500, that had a Sharpe of 0.27 over the 62 to 2008 period. And the beta was 1.0 by definition, the return 10.3% annualized. For retail investors, a beta 1.0 portfolio, that is my trimmed beta 1.0 portfolio, where you just take the stocks that are closest to a beta of 1 and exclude the high beta stocks, you actually can increase your Sharpe and have the same beta. And so if you're interested, if you're a retail investor and you care about keeping up with the Joneses, you want to have a beta of 1. That's risk-free. And you can actually get, in this example, 200 basis points extra by doing this. And that's what generates the Sharpe. It's slightly higher volatility. It goes from 15 to 17%, but you have the same beta. And so this seems like an obvious no-brainer. And the increase in Sharpe is on the order, it's above the magnitude of going from active to an index. So if you thought that Bogle's index idea was a good idea, because basically you're getting rid of 100 basis points of costs, that's very predictable. Well, in the same way, by going to beta 1.0, by eliminating the really low returning high beta stocks, you can increase the return of your portfolio. You get a slight positive weighting on these value and size factors, which tend to be positive, and you have a beta 1. So that seems like a good sell to retail investors. It's kind of non-intuitive, but again, 20% of the market is now index investing. This dominates index investing the way index investing dominates your active portfolio manager. However, for B school grads, you might say, hey, I want to maximize my Sharpe ratio. Well, we got something for you. Go long the low beta portfolio. Sure, you'll have tracking error, but all you care about is your Sharpe ratio. And you can have a higher Sharpe ratio with the low beta portfolio. And your beta will be low, your return will be slightly higher than the S&P 500, but at a much lower volatility. And the MVPs, the minimum variance portfolios, have this similar dominance to the low beta focus. Either way, you basically get a slightly higher return because you're investing in the low volatility stocks, and that means you're avoiding the high volatility stocks that are part of the index, and you're getting 30 to 40% lower volatility. So for anybody who's gone to B school and CFAs and people who read about Sharpe ratios, this seems like an attractive way to go. And lastly, for finance professors, you want to be zero beta because you know that beta should be bad. You want your stock index to be indifferent to where you're in the business cycle because you want to have high returns when your marginal utility is really high, such as now. And so because there's no predictability and the tracking error, these are great. And it turns out if you're long the beta 0.5 and then short the S&P 500, you can have a beta 0. That's pretty straightforward. You'll be within 0.1 of that in terms of your beta. And your Sharpe ratio will be 0.39, which is greater than the S&P 500. So that strictly dominates, and you should there make about 3.3% above the risk-free rate with this kind of strategy. So that seems like a good idea. So finance professors, your business school grads, your CFAs, and your average retail investor who's just very envious all have strategies that play off of basically simple beta arbitrage, off the fact that the CAPM standard theory does not work